This is Barry Knapp with Ironside's Macroeconomics. I'm recording this podcast and video on Monday evening, February 21st. You'll all be receiving it on Tuesday, the 22nd. I hope everyone had a good President's weekend. Our note this week was titled Retest. It was a particularly dense note. I'll do my best to keep this podcast and video as succinct as possible, but this was a great week for you to all have been a subscriber because there's lots of really good details in this note. As I'm recording this, S&Ps are trading at 4280. That's up 30 from where they opened. Obviously, lots of concerns about Ukrainian invasion. Crude is up $2.75. 10s are down 6 basis points in yield. 30's not down nearly as much, and the front end not down as much either. So there were a couple of interesting things this weekend in addition to what we put into the note. One was we got a speech from Fed Governor Bowman, who was the community banker. She doesn't typically make monetary policy speeches. One of the things we wrote about in the note was a burgeoning Fed credibility crisis, and we wanted them to have optionality. We actually think they're in a position where if they approach the inflation problem passively, the market's really going to press them on it. So when John Williams said on Friday, the New York Fed president, supposedly part of the troika, though we're a little dubious about how much sway he really has over the committee, when he said that he's only in favor of 25 at the March meeting, I think that's a bit of an issue. Yes, they may be able to get away with only going 25 if they pre-announce balance sheet contraction. But if we get a bad number, another bad CPI number between now and then, they look like they'll never get out in front of this thing. I don't really believe they ever really will get out in front of this thing, but at present, their summary of economic projections only has policy going back to neutral and inflation magically going away, as if policy had nothing to do with any of this. Of course, we know via the lens of the real estate market, it surely did. So that was one of the interesting things over the course of the weekend. One other note, when we discussed spreads, and I'll come back to that agenda for this week's note, we neglected Chinese outflows in our discussion of spreads. So we've amended the note, and I'm going to talk about that through the course of this podcast and video. And then finally, one of the things that occurred over the weekend since we published our note was we got service sector PMIs from Australia. We also got Japan, which didn't look so good. But in Australia, France, Germany, and the UK, we had big bounces in service sector PMIs as the effect of Omicron started to fade. This was one of the themes in our notes that we're getting some decent growth related numbers. Inflation numbers are terrible, but growth numbers are pretty good actually. And we don't think we've reached any demand destruction yet. So on to the agenda for this week. The first part of the note was all about the retest of the late January low and what played into that, the Fed credibility issues, the bad inflation numbers. But on the other hand, decent growth numbers, which is why we think it's a retest, not a whole nother leg lower. And we think you ought to be putting money to work below 4,400 in the S&P. We, of course, closed at 43.48 on Friday. So Tuesday's a pretty good opportunity to put some money to work. The next section of the note was no demand destruction, at least not yet. Third section of the note was pandemic effects. We've gotten a series of indicators recently, and they really do bring to light some of the trends that were already in place pre-pandemic and these effects that are going to persist long after the pandemic is done. And then our final section, which is a real cautionary note on fixed income spreads based on what happened back in 2015. So again, I'll come back to that shortly. First of all, on the retest, recession-related lows do tend to have V-bottoms. We got pushed very hard on this back in March and April of 2020, and that's not the way the market tends to react to recession-related bear markets. They make their lows and they tend to rebound fairly quickly. These policy normalization related corrections are different. 94 had a retest. 04 had 3 waves lower. The lowest low actually came in the second wave shortly after the second rate hike. And then at the end of QE1 in 2010, we had a retest of the low. In 2011, we had at the end of QE2, we had a retest of the low. The end of zero interest rate policy, something we've already written about, when the Fed started raising rates at the end of 2015, 2016, we had this right out of the gate sell-off that was very similar to this one. Again, you had a 50% retracement of the initial move lower and then a retest of the lows, but that was it. The average duration of these Fed policy normalization related corrections is 50 days. We are just about at 50 days. So we think this really is a retest and that you ought to be putting some money to work in energy, industrials, materials, financials, healthcare, and small caps. And that's what we'd be doing on Tuesday morning. So there is a big question about Fed credibility. We wrote a lot about that in the notes. We just mentioned Michelle Bowman's speech. We think that may have been a little bit of a message from the chairman. Who knows? Maybe he doesn't want to speak until he's been voted on by Congress. Whatever the case, we will probably hear from him between now and March, and they really should maintain this optionality. They run the risk of making things worse. I know it sounds counterintuitive, but in fact, we think a Fed that's on top of the inflation problem and is willing to use their balance sheet aggressively is going to get a much better market reaction even in the near term, but certainly in the intermediate term. So moving on to no demand destruction, at least not yet. We're very much vindicated by the January retail sales number. We'd argued that the Census Bureau was having the same seasonal adjustment problem in 2021 that they had in 2020. Sure enough, they got a sharp snapback in retail sales in January 2021 and again in January 2022. And if you listen to Walmart, what they said on their call, their comparable store sales, there's no denigration of demand at this point. It still looks quite strong. There's a couple of other things that came along last week that we think bear noting as well. We've heard some talk about negative earnings revisions. We don't see it. We have a measure of earnings revisions. We went through and looked at it sector by sector. We don't see revisions rolling over at all. Sure, they're not as high as they were in the early stages of the recovery. That's obvious. It's like when ISM went to whatever it peaked at, upper 60s. We're not going to stay at that level. These are rate of change indicators. But revisions are still strongly positive for energy, financials, consumer discretionary. They're net flattish for tech, materials, healthcare, industrials, staples. There's no revisions problem. Earnings are not headed south at this point, at least based on analyst estimate revisions. And those tend to follow price. Price has gone down and revisions are still not going lower. More macro data that we think is interesting. The housing numbers were kind of interesting last week for sure. Single family permits are very strong. Houses under construction are approaching record levels. So there's lots of residential investment in the pipeline that'll add to GDP. One cautionary note, though, about housing: the existing home sales showed investors and cash buyers crowding out first-time buyers. This is why the Fed needs to start shrinking their mortgage-backed securities portfolio. And then finally, just a little broader thought process for everyone. One of the ways you estimate monthly GDP is you look at total hours worked, and you add to that trend productivity. So total hours worked were averaging, or in the 3 months prior to the Omicron wave in the December and January reports, we're averaging 6.4% annualized, right? We've got strong job gains. We've got hours worked picking up. All those things were going on. Then you hit hours worked because of all the people that got sick or tested positive, couldn't go to work. We think we're going to bounce right back to trend in February, if not March. And so if you take that 6.4, add to it 2% trend productivity, we're still talking about 8.4% trend nominal GDP. Very strong stuff, the type of stuff that drives earnings growth, revenues and earnings growth higher. So we just don't see any sign of deterioration in underlying economic demand at this point. Moving on to pandemic effects, there's a bunch of numbers that came out over the last couple of weeks that really just point to some things that were already in place that were changing, and the pandemic exacerbated or accelerated these processes. First was import prices. We're not going to get a negative impulse from import price deflation. And so we talked about that in the note. PPI for consumer goods. U.S. manufacturers had no pricing power for decades during the China shock. They do now. And those numbers are increasing at what clearly looks like an unsustainable rate, but that's pipeline measures. So looking for goods prices, core goods prices to start to roll, yeah, we think it's going to happen. They're not going to keep increasing at a 11.5% annualized rate, but there's no signs that the pipeline measures are slowing at this point. And that's worth thinking about, on an ongoing basis, import prices and PPI for consumer goods and what that'll mean for prices on a go-forward basis. We then talked about the Atlanta Fed wage tracker, which came out within the last week, and that showed even a stronger impulse for the lowest quintile workers relative to the highest quintile workers. We wrote about labor share of income, which was in a 61 to 66% range from the 50s, 60s, all the way through the 90s, dropped to 56.6% in 2014, right about the time when the economics of manufacturing in China and shipping all over the world were fading. We started to see at that point labor dynamism picked up. That Atlanta Fed wage tracker switchers versus stayers is near its all-time high as well, got a little better last month. All these things indicate labor share of income is really starting to improve. And again, that was something that was already in place pre-pandemic, but the pandemic just accelerated it. And then finally, we wrote a little bit about e-commerce market share. So when Cathie Wood talks about deflation and all the deflation of disruption, the deflation in the consumer sector is a consequence of e-commerce and the Amazon effect. That's in the past, in our opinion. And the chart that we show here shows you, you shocked e-commerce much higher during the pandemic, but now we're back to the pre-pandemic trend. Now, mind you, that trend is a little curve to it, and we're not arguing that e-commerce has peaked. We're just arguing that it no longer is a price shock the way it was in the 2000s and 2010s, that now it's more about convenience yield and how people do things. So that's it on the pandemic effects. Now the real actionable part of our report this week, which was all about this liquidity trickle and what happened in 2015. I arrived at BlackRock in mid-2014, about halfway through the taper one. Oil prices peaked right about the time I walked in the door. One of the first projects I did was to look at the effect of shale energy on the broad macro economy. And one of the things I stumbled on pretty quickly was the work the New York Fed had done on petrodollar recycling. And sure enough, oil prices started to crumble. We'd had a big shock in supply, some 5 million barrels per day, extra barrels per day had come online. It took a period of time, just like in the 80s and 90s, prices cracked, went down 75%. We calculated what that meant for petrodollar recycling. It was a loss of over $600 billion in demand for US fixed income. Take that together with the $1 trillion that the Fed had been taking out of the market that was no longer doing so in 2015, and the Chinese outflows related to their heavy industry hard landing that led to some 400 plus billion in outflows, all of which combined to reduce demand for US fixed income by about $2 trillion in 2015. We walked into meetings every morning, and the person that traded the CMBS book had no bids, no deterioration in credit, but no bids. The CLO book, high yield, everything just went straight wider. Treasuries held up pretty well, but fixed income product got absolutely eviscerated. This is the history of QE. What QE really does is creates a reach for yield bid for anything that looks like a bond, even within the equity market. But the effect on fixed income spread, illiquid fixed income spread product, is much greater than it is on equities. Equities have earnings. This other stuff, all you're doing is hoping to get back par. And so stuff went way, way wider. One example is high yield X energy went from a 3.3 yield to a 7.1% yield. This is what we think we could have in store for us in later 2022. The Fed's still buying. They're going to stop buying. Then they're going to stop reinvesting. They may even sell some high coupon mortgages. The net delta is even bigger this go around. We could have absolute carnage in fixed income spread land, not because of credit, but just because of liquidity. Now, could that lead to credit problems? Sure, if people can't roll stuff over. We don't think there's that much out there that's really going to cause anything systemic. The levels of debt in the non-financial private sector is not that high. CMBS markets, any of these things, we don't really see it as becoming super systemic, but we definitely would think it warrants caution in holding any fixed income spread product. So that's it for me this week. Again, this was a really juicy note. It's a week you should have been a subscriber to get it. We hope you all consider becoming one. Barry Knapp, Ironsides Macro. Have a good week, everyone. Thanks.